one crash, one safety car, one race win, and a Formula One scandal that nearly destroyed one of the most powerful men in racing. His name was Flavio Briatore. He was not the driver crossing the finish line. He was the man behind the team, the deal maker, the strategist, the boss who helped turn Formula One teams into champions. Briatore became famous for his role with Benetton and Renault, where he helped guide some of the biggest names in racing, including Michael Schumacher and Fernando Alonso, to world championship success. To many people, he looked like a genius of Formula One, a man who understood power, pressure, and winning. But then came Singapore 2008. During the race, Renault driver Nelson Piquet Jr. crashed. The safety car came out, the race changed, and Fernando Alonso went on to win. At first, it looked like normal Formula One chaos. But later, the truth became explosive. Piquet claimed the crash had been planned to help Alonso's strategy. The scandal became known as Crashgate. Formula One was shocked. Briatore left Renault, and in 2009, he was handed a lifetime ban from Formula One. For a moment, it looked like his racing story was over. But in 2010, the ban was overturned. Years later, Briatore found his way back into the Formula One world, returning in 2024 as an executive advisor connected to Alpine. Flavio Briatore's story became a warning about ambition, control, and reputation. Because in Formula One, speed can make you famous, but one planned crash can follow you forever. A single trader inside UBS secretly built billions in hidden losses before anyone noticed. This is UBS, one of the world's biggest and most respected banks, operating a fast-moving trading desk in London where money shifts in seconds and pressure never stops. Inside that environment was Kweku Adoboli, a trader handling high-volume financial positions every day. At first, everything looked normal. Small trades, routine activity, standard market exposure. The system showed stability. Reports balanced. Nothing appeared unusual enough to raise concern. But behind that normality, something was changing. Positions started to grow quietly, not in a way that triggered alarms, but in layers, built through trades that were designed to offset risk on paper while increasing exposure underneath. And because the trading floor moves fast, the system relied heavily on what was being reported, not what was quietly forming in the background. That's where the danger built. Over time, the hidden exposure became massive, far beyond approved trading limits, but structured in a way that delayed detection during routine checks and reporting cycles. For a while, it worked, until the market shifted. When conditions changed, the hidden positions started to show losses. Suddenly, what looked like normal trading activity revealed billions in unauthorized exposure sitting inside the bank's system. UBS reacted immediately. Emergency reviews began. Risk teams moved in. Positions were rapidly unwound as they tried to stop the losses from growing further. But the truth was already exposed. A single trader had built up billions in unauthorized positions, creating one of the most damaging rogue trading incidents in modern banking history. The losses were huge. The shock was immediate, and Kweku Adoboli was arrested and later convicted. Afterwards, banks worldwide tightened trading controls, risk monitoring systems, and internal oversight to prevent hidden exposure from building again. But the lesson stayed clear. Because in the end, the UBS rogue trader scandal wasn't just about one trader breaking rules. It was about how dangerous it becomes when a system tracks activity but fails to see the risk growing underneath it. Nearly $100 million moved through a banking system before anyone realized the structure behind it didn't fully add up. This is the case involving Mahendra Mukhijani, CEO of California-based Cantor Group V and Western Alliance Bancorp. At the center of it were large-scale commercial lending and financing arrangements, structured deals that, on paper, looked legitimate, organized, and properly documented. Big transactions, corporate agreements, banking paperwork that appeared to follow normal procedures. Nothing obvious, nothing immediate, nothing that raised alarms at first glance. But over time, certain details began to stand out. Some financial movements didn't align cleanly with the underlying business activity they were supposed to represent. The structure of the transactions became unusually complex compared to the scale of operations involved. And in banking, complexity is often where risk hides in plain sight. As the flow of funds continued, compliance teams and investigators began reviewing the relationships and transactions more closely. What they allege they found was a pattern of financial arrangements that didn't fully reflect the actual risk and value being represented, raising serious questions about how nearly $100 million moved through the system. As scrutiny increased, the situation escalated quickly. Internal reviews turned into deeper investigations. Transactions were dissected line by line, and legal processes were triggered to examine the full structure behind the deals. Eventually, the case became a major example of how sophisticated financial systems can still be vulnerable when complex structures mask what's really happening underneath. The fallout pushed banks to tighten oversight on commercial lending relationships and improve risk detection in large structured deals. Because in the end, this wasn't just about one company or one CEO. It was about how quickly financial trust can break down when structure looks clean, but the underlying flow tells a different story. A government rescue program meant to save businesses was quietly turned into a multi-billion-dollar fraud pipeline. This is the PPP loan wire fraud wave during the COVID-19 era. When the pandemic hit, governments rolled out emergency relief programs to keep businesses alive, protect jobs, and prevent economic collapse. One of the biggest was the Paycheck Protection Program. Money had to move fast, because survival depended on speed. Loans were approved quickly, funds were sent directly to business accounts, and restrictions were reduced so help could reach people without delay. But that speed created a blind spot. False applications started slipping in, businesses that didn't exist, inflated payroll records, stolen identities, and companies created only on paper to qualify for emergency funds. On the surface, everything looked legitimate. Forms were filled, bank details were provided, and applications passed initial checks. But many of those businesses were not real in the way they claimed to be. Once the money was dispersed, it often moved quickly again, wired between multiple accounts, split, transferred, or moved in ways that made tracking harder in real time. That's when investigators started noticing patterns. Repeated identities, shared banking details, similar application structures across different filings. It wasn't isolated abuse. It was systematic exploitation of a fast-moving emergency system. As federal investigators stepped in, they began tracing wire transfers, bank records, and application data across thousands of cases. What they uncovered was a widespread network of fraudulent PPP loan claims that had siphoned off massive amounts of emergency relief funds. Once exposed, arrests followed, accounts were frozen, and recovery efforts began across multiple jurisdictions. But not all the money could be recovered, and the impact forced governments to rethink how emergency funding systems can be protected without slowing down legitimate help. Because in the end, PPP loan fraud wasn't just about stolen money. It was about how urgency can become a weakness when oversight cannot keep up with speed.